Because there's no judgment from society. Like when you're riding a bike and you fall, everyone's like, hey, get back on, do it again, try it again. You might fail again, but try it again. But with money, nobody does that, okay? It's judgment. You lost money. You're a fool. You're foolish.
Yeah,
you're
you just started investing and you lost money.
Yeah,
idiot.
And so... All right, welcome back to another episode of How to Invest in Commercial Real Estate, and we are super excited today for our topic. We're going to kind of address the psychology of investing. We know that it's really hard for people to part with their money, and so today we're going to walk through some of the reasons why some people don't invest. What are the areas of struggle? What are the fears that they have, the unknowns? But first, let's get into a couple updates. Braden, what do you have for us?
Yeah, so we are finishing construction. We have a lot in construction still, but we're finishing construction on a lot of assets, and we have a lot on the market for sale right now, and we are encountering a lot of offers. We're getting a lot of offers. We're starting to see a lot of activity on that, so we're optimistic that we can get some stuff sold here pretty soon. I know, that's a big update on all of these development deals, right? We build it, we sell it. When are they going to sell?
Yeah, people are ready to get their money back.
Yeah, of course. And they're ready to get that redeployed in the next deal, which is the Burleson Learning Experience we're currently funding for right now. So super awesome deal. We'll mobilize construction here in 30 to 40 days. We already have our civil permit in hand. Architectural drawings are almost done. We'll get those submitted in. We've already got our signed contract with the contractor that's in budget. We've got the construction loan that's about to close. We are good. So excited to get that project. A little bit of
room left for investors that they're watching this.
Yeah, maybe depending on when this releases. But yeah, we're still fundraising it right now. It's been up on the site for about a week now. So yeah, if you're interested, go to the website, check it out. There may still be room. If not, we'll get you on the next one because we should have the big sale leaseback under contract now. I mean, by the time this comes out, it should be under contract. We're circulating entity names and we're circulating the PSA for signature. We've negotiated the lease. We've negotiated so much stuff, but we're almost under contract. And I know we've been talking about it forever. We've had a bunch of people email that said, hey, send me information about the big sale leaseback deal, and we will get it out soon. So super excited about that one.
Love it. Well, okay. What else?
Well, no, that's it. I was just going to say, if that's all the updates, I was going to say, you're talking about the psychology of investing. And we have people who listen to the podcast, they watch the podcast, they know what we do, but they're telling us they still won't invest, still don't want to invest, or just can't really pull the trigger on it. So why do you think that is?
Well, first I want to give an update on how we got this topic today. Braden and I having lunch, and a really good friend of mine came up, and he was just saying, hey, and we were like, hey, we were discussing the podcast and what topics. This was literally an hour ago, and he's like, hey, you need to go over, like the scarcity mentality and the fear of doing your first deal.
This is somebody who watches our podcast.
Somebody that's known me for a long time and has never invested in a deal and watches the podcast and has seen all the information, but still is trying to get over the hump of getting that first investment in. So anyway, that's the preface of the show. So go ahead.
Okay.
He said I was doing a great job, by the way. He didn't mention anything about you.
Really?
Yeah.
That is true. He did.
Yeah.
Well, you're going to have to give me this guy's name. No. In my view, I think it's just the kind of the unknown, right? Because there's a lot of things that people can invest in that are sort of the norm, right? Their 401k at work. They can go find they got a friend of a friend who's a stockbroker, so they give them money and this guy or woman picks stock for them. And so, but investing in commercial real estate is not the norm.
Yeah, what were you saying before the show? It really people kind of stick inside their circle of influence.
Yeah.
And so if you've got 5 of your best friends that are making money in commercial real estate, chances are you're not going to have much of a hesitation in doing a commercial real estate deal. But if you don't have any friends in commercial real estate, that can be a barrier. All they're doing is 401k and Roth IRA and all these kind of traditional things that feel safer because everybody's doing it. Mm-hmm. If everyone is doing a thing and no one's getting slammed, no one's losing all their money, well, then you think, oh, that's safer than commercial real estate. Mm-hmm. It may not be safer, okay, but the perception is that it's safer because you don't know anybody doing commercial real estate. So I think that was one of the reasons we think maybe people are having a hard time.
Yeah, knowledge brings comfort and security. So what you don't know about, you could hear all of these people making money in commercial real estate or real estate in general. We know so many people killing it in real estate. But if you're not around those people and you don't know anything about real estate, it's going to feel like you don't know anything. So then it's going to feel like a massive risk. And then you don't take massive risks. People don't take massive risks. They don't even come close to taking a massive risk. I try not to take massive risk, and I consider myself a risk taker.
Yeah.
Like we were talking about going, what is it? The thing where you slide on the cable, zip lining in Costa Rica. Mm-hmm. I'm like, I don't know if I want to do that. Anyway, so we're constantly looking for things to justify not taking risks. So just being around people and starting to gain the knowledge, right? Starting to take that action. It's like, okay, I'm going to look into maybe how, or, if there's, I'm not going to use the zipline example anymore, but just for real estate, there's so many people who are just like, okay, screw it. I'm finally getting in a deal. What's the minimum? I'm giving you the money and I'm just, I can't think about it anymore. And at least I'll learn. And that knowledge and the process of going through it helps increase their awareness and their knowledge. And then it doesn't feel like a risk anymore. And then they're getting into the next deal because they kind of understand how it works, right?
That's a good point. And it goes back to the psychology portion of it. The risks don't change, guys. The amount of risk that you're going to incur in doing a real estate deal doesn't change. But I'll throw it out there. We have investors that are in 10 deals, 15 deals, 20 deals. And so they don't even think about it, right? But that first one, it's totally different on the psychology of it because you haven't done it before, and you're like, okay, what if I lose all this hard-earned money? This money, $25,000, this took me a year to save. This took me 5 years to save. I can't just give it away, and what if it doesn't go well?
Yeah, that's
what they're battling is that psychology.
It really is, because when people are the first-time investor, like you say, one of the things that I get from them the most is, how am I going to lose my money? How could I lose my money? Am I going to lose my money? And we have to kind of walk through it. So maybe we should sort of do that. What are the risks, the perceived risks, in investing in commercial real estate, and how do we counteract those risks?
Yeah, so there's an interesting video. Maybe we can pop it up in the post edit. But basically, Tony Robbins is interviewing this guy, and he has him close his eyes and look around the room for anything that he sees that is brown, right? And he closes his eyes, and then he says, "Okay, now let me know everything you saw that was red." And then he did the exact same thing with red, but he popped out a different color. Oh. And the idea is that what you're focusing on, you're constantly looking for those things. So yeah, let's go down that path of how can I lose my money, right? Because we're actually thinking about that. Yeah. On every single deal, we're asking, how can we get a cataclysmic failure? How is the bank suing us? How are we losing the investors' money? Like, how could that happen on the deal? And we're talking through that on every single deal because there's not a lot of ways that it could happen.
Yeah. So I don't know the answer to this. So, and we didn't talk about this, but Joel, with your previous experience in precision and now precision and criterion, has an investor ever lost money?
Yeah, that's a great question. And we have to preface it, guys, that in these types of investments, there is a chance, if it's small, if it's large, of you losing your capital, okay? Mm-hmm. We have to say that. In any real estate deal where especially the ones like we're doing where we're leveraging and we're putting 25% down and we're borrowing 75%, there is that chance.
Yeah, I'm glad you said that.
But I've been doing this now. I've been real estate investing for over 20 years, and I've been syndicating with investor dollars since 2010. And good news for my investors, any of the amount of money that I lost, I did it with my own money before I started taking investor dollars. But we've done now, could it be 50 deals, 75 deals, even more, and we've never lost $1 of investor equity. And so that's important because if you want to know the odds of a catastrophic failure of you losing all of your money, well, that's never happened in the history of my investing career. But I'm not saying it can't happen. But you have three guys, and with Andy, our business partner down in Fort Worth, you have four people. And like Brayden says, we're literally trying to find what are the ways that we're going to get hurt on this deal. And we're bringing all the experience, all the mistakes that we've made throughout the years that have cost us money. And we're bringing all that experience to the table to make sure that doesn't happen for you guys. And that's what we want to tell you is that we're not – the chance is there, but losing 100% of your capital would be a very, very rare event. So what are the alternatives to losing 100% of your capital?
Well, let's stay on that for a second.
Okay.
And this isn't a great analogy, but do you think anybody's ever lost money in stocks? I've lost money on a lot of stocks.
Of course, yeah, because
I've made money on some, but I've lost money.
So this is a
Little
good
different.
point.
It's a little different, but go ahead.
Yeah.
It's vastly different. It's total freaking opposite, right?
Yeah.
Because stocks are a public market. Like I know Monday morning the stock market is going to open, and I know I can sell all of that shit. I know the bank could come and take it and sell it if I was trading on margin or whatever. There's a public market for it, and you can sell it. And I think that is what screws with people, and that's why they lose money in stocks, is because there's a public market for it.
Right.
But then that's the same reason they're not giving us money, is because they're like, well, I want to have control over my money, and I like to be able to sell it when it's high and buy it when it's low, and I'd like to see the value every day.
Yeah, right.
Like, okay.
They love that control.
Yeah. I wish we were selling stuff faster for better prices, but we're selling it and we're selling it for good prices, especially considering the economy and especially considering what we underwrote. So yeah, it's not a liquid public market. It's very illiquid from the limited partners perspective, and even our perspective. We're in control of the deal, and it's illiquid.
Yeah.
Like I can't sell that Monday if I wanted to.
Yeah, people really don't like the thought of not having control, right? They're giving us their money, and then they're just, they can't see the value go up or down every day. They're just kind of relying on us. Whereas with other equities like the stock market, they can just kind of go into their account online.
They feel like they have more control because they can push a button and get all their money back. If you invest $25,000 in a mutual fund, if that thing loses value at any time, you just like push a button and you get 98% of your money back. Mm-hmm. That control, I think, is comforting to people, and that may be another reason why people have a hard time pulling the trigger, because once they give us $25,000 or $50,000, they kind of have to let it go for a year, 2, 3, 5. And so there's a lot of trust there. And so if they, going back to it, you have these factors that I want people to have takeaways. You have a lack of education or knowledge of the subject. That's number one. It's the fear of the unknown.
Yep.
Then you have the fear of loss.
Yep.
Like money. I'll get back to the psychology of that part, but you have the fear of loss. And then what was the last one is the lack of control. So those three things are most of the psychology of why people can't pull the trigger. But I think maybe the biggest one is this idea of the fear that people have of losing money. Mm-hmm. And I just want to spend a couple minutes on that, because that really drives a lot of behavior in society. And, we were talking about it before, and I brought up the example of riding a bike. People are willing to fail at a lot of things in life until they learn. Okay. And so, because there's no judgment from society. Like when you're riding a bike and you fall, everybody's like, hey, get back on, do it again, try it again. You might fail again, but try it again. But with money, nobody does that. Okay. It's judgment. You lost money. You're a fool. You're foolish.
Yeah.
You're
you just started investing and you lost money.
Yeah.
Idiot.
And so in the shame, that we feel, and that paralyzes us, guys.
People
and
hate
so
losing money.
you never invest, or you invest in a savings account in the bank, and you feel more secure that way. And that safety and security keeps you from venturing out. But it doesn't have to be real estate. We're just encourage you to get past this psychology, because you're never going to get rich saving money. You're never going to get rich with money in the bank. Inflation will always outpace your interest rate that the bank is paying you. So when your money's in the bank, you're not losing it, but it is going down in value. So you are essentially losing a small piece
that's how
every
banks
day.
make money.
That's right.
Yeah.
So let's talk about cash and what I would consider the different levels of risk tolerance that most people have, and just kind of the correlated investments in between. Cash is trash. Like if you haven't figured that out in the high inflationary environment we're in right now, then you're living under a rock, right? Like you have to buy things. As soon as you start buying appreciating assets like real estate, not only is inflation not working against you, but it's working for you, because it's helping drive rents, and that's directly correlated to the value, the appreciation of your property. So you're not losing multiple percent, 3, 4, 5, 6, 7, maybe in some years percent on inflation on your cash, but now you're appreciating 3, 4, 5, 6, 7% a year on that asset. And then you get to the next level, which people are like, let's buy a CD or a bond or a high yield, form of debt, it's maybe 4 or 5 or 6%. You know what I mean? Still very, risk adverse, not really doing anything for them. The next step is maybe a public market. historically, you can invest in the S&P, get a 9.5% return,
eight maybe
8% return over the past 30 years. You have control. You can put it in a variety of different places. You can do it on an app. You can do it through Merrill Lynch or whatever. And then the next step is really where people lose it and they don't have it. But in this book we're reading and I got for us right now, Tony Robbins is interviewing Ray Dalio, and they go into some of the statistics about how much wealth is actually stored in private investments outside of the public stock market. And I believe there's way more wealth stored in private investments, way more wealth. Yeah. And the average return of that wealth invested in private, illiquid, non-public companies, just like we're doing with real estate, the average return of that is 15%, right? It's 50% higher than what you would get in the stock market. But those people had to get comfortable with giving their money to somebody else and letting their money and their relationship and that connection and that investment work for them instead of the control that they have to have over their Robinhood app or their Merrill Lynch account. It's like, I have to see this, have to know what closes today. It's like, dude, I love giving money to people. It's like, you worry about it. Let the money and the investment worry about it. I don't want to have to worry about like what Apple stock is doing or what interest rate my cash is on. Like I don't want a ton of cash. I want enough cash flow to live on, and then the rest can just kind of go to make more cash flow so I can live on it. I mean, it's like a river of water. I don't need this big dam, this big reservoir. I just need like a little bit every now and then.
Well, and so to that point, I want to talk about that because we started the podcast because we wanted to make commercial real estate accessible to people. We wanted to make it easy to understand and to get more people in the investing game because we know it changed our lives and we wanted to change other people's lives. But if you're listening to the podcast and you haven't got over the psychology of investing in a real estate deal with us, with not expert. I mean, I hate to call myself an expert, but we've been doing this a long time. You're never going to get to where you're doing it on your own. And that's the ultimate goal. And so what I'll say is, if you think back, if you haven't ever invested and you think back, the first deal you saw from us, let's say 5 years ago, if you would have put a little money in that deal, we'd have made you money. And think about how many more deals you would have been invested in over the years because you did that first one. Okay. And so, but the longer you wait to do the first one, you're just delaying the opportunity to make above average returns. And once again, it doesn't have to be with us. It can be with any what's perceived as a riskier investment that has a higher return profile. But until you do that, you're never going to be able to get in the game that private equity is playing in, which are above average returns. And we've already done shows on the difference, 8% versus 15% does on your money over a generation. Yeah. It's life-changing. And so that's what we want to do is to help you guys get over that psychology hurdle in order to say, hey, I can do this. It's most likely going to make me money. And real quick, before I pass it on, I want to talk. We talked about losing all of your capital, but things don't go well in our deals. We've had so many deals that didn't go perfectly.
Yeah, mistakes are made. We're humans dealing with other humans.
Yeah, we trusted an individual. We trusted a contractor. We trusted tenants to actually pay on their lease. And sometimes that stuff doesn't happen the way we want it to happen. But if you want to talk about it, we can give you example after example of, well, that was a problem for us that we had to find a solution to. And that's part of it. We don't stop. We don't run away. We don't act out of fear and say we're never going to do that again. Mm-hmm. Each time something doesn't go right, we get better at our job. Because we have all that experience, and experience is a necessary teacher to help us know, okay, what pitfalls, what are the 100 mistakes that I made over the last 8 years, and how do I incorporate that into this deal to make sure those don't happen again? And so each deal gets a little bit better. But could there be a deal, like we have a deal, I'll mention it, Colonial Building down on Cherry Street, where everything that could go wrong kind of did go wrong. COVID hit right after. They started widening the street, the construction. They canceled the market place that the fresh.
They had a weekly farmers market.
Farmers market canceled.
Roof problems didn't.
Roof problems. Exterior updates. Yeah. We basically had almost 100% turnover. Literally almost 100% of the tenants moved out. Okay, so we've had to pause distributions, but I promise you, we haven't lost $1 of capital. And I think that eventually we will double, if not triple, everybody's investment in something that has gone has not gone very well at all from a standpoint of things going right. But that's what's great about real estate, is that it's very forgiving in that sense. And we're taking a lot of necessary precautions. Like on that deal, we over-raised capital. So we had money in the bank for things that did happen. So, if you have a sponsor that doesn't, raise any extra capital and hasn't made any of the mistakes we've made and doesn't foresee some of the things that could happen, then yeah, there may be some additional risk there. Mm-hmm. But anyway,
I get asked regularly why we do this, right? Because hold on, I got to put my phone on silent. I get asked regularly why we do this, because it kind of looks like it costs money to put this show on, because it does, right? It's expensive. And I get asked on the other side by partners of ours, like, why are you guys taking $25,000 investors? What are you doing?
Yeah.
And I love telling that story because we do it for you guys. Like, we have no business taking $25,000 investments. It doesn't make or break the deal. We love having you. That's why we do it. We love having you, and we love when somebody says, "This is my first deal. I'm excited to get in for $25,000."
Oh yeah.
I freaking love that. I live for that.
It is exciting.
And I perform, and we rise up to that challenge. We talk about it all the time.
No, it's super cool. And obviously it would be a negative if that first deal didn't go well. But if that first deal goes right for them, and we do everything we can to make sure it does go right, then we've changed their life, because they're going to invest in the second one and the third one and the fourth one. And their financial picture over the next 10, 20 years is going to be drastically different, all because we got them to take that step. And some people don't take the step unless we're out there telling them how easy it is. We're doing the podcast. We're talking about how to do it, what the risks are. All of that stuff gets them over that hump in an asset class that they never would have invested in the first place. And so 10 years from now, 20 years from now, I hope we have an army of podcast listeners that have invested with us. And they're like, man, now I'm in with 10 different sponsors. I don't even invest just with Criterion. I'm invested with this guy over here and this apartment person over here and this fund out of California here. That would be awesome.
Yeah.
So that's to your point. That's just why we like talking about it and doing it, because it is so influential in our lives.
Yeah, and everyone loves to. I don't know. Maybe not. But like buying Apple stock now, it's going to make you some money. If you bought Apple stock or Netflix stock or Amazon stock a decade ago, like, you made great money, but those companies were private companies. And the people who really made the money invested in those companies when they weren't public, right? So just look into the statistics of real estate returns, private equity returns versus the stock market, because it's just freaking huge. And I think that's the biggest holdup for most people, is how, like, I have to invest in the stock market. How could the stock market go wrong? I can't give it to these guys. What if Brian gets hit by a bus? Like, people ask us that, like, what happens if you guys die? Like, we're dead. There's management companies. There's asset managers. We have infrastructures. I'm just saying, like, the real estate is not dependent on us surviving to cash flow and appreciate and be a good investment. But it goes to show how little people know about real estate investing. Like, just get in, do some research, do some data, or get some data, invest in a deal, talk to a friend that's invested, talk to a management company, like, start to learn. And then it's not risky, right? Because you just actually understand, for this to cataclysmically fail, like, all of these things would have to happen at the exact same time. And the probability of that happening is just, like, so slow. But at the exact same time, the probability of it being within our normal projections is very high, very high. And at the same time, the probability of it being way exceeding expectations and being an absolute home run, which we've done numerous times. We hit accidental home runs, right? Our Plaza West deal, the El Luchador deal. I know Stephanie Promenade in Las Vegas, right? Home run deals where you're mitigating the risk. The probability of it performing with what you thought is very high, but that probability, that 10 to 20% that you're going to accidentally hit a home run and get somebody a stupid return, is there on every deal. It really is.
All right, guys. So the point I wanted to make on that is the risk of the deal isn't changing. The only thing that changes is your knowledge.
Yeah,
that's it. The guys that invest with us on 10 deals, 15 deals, they don't see it risky. Right. But someone that's never invested, they think it's risky. The risk profile is the same. Yep. It's only your knowledge that is what changes the risk. That's why we wanted to talk about the psychology of investing. It's that point exactly. So if you are struggling, if you aren't sure that you want to get into commercial real estate, that you have some fear, hit us up. Ask us your questions, right? How many deals have not gone the way you wanted it to? How many investors have reinvested with you? What are the chances that my deals do above the returns that you're talking about? What are the chances that the deals do less? Right? Email us, call us. We'll walk you through it. There will be zero pressure to invest. But we're trying to get you over that hump, because once you're over that hump, you're going to invest multiple times, and it's going to pay off for you. So,
Hump day.
all right. Till next time. Thanks, guys.
See ya.
Thanks.